Hello and welcome to another episode of Let's Get Rich with Pattu. No pleasantries today, diving straight into the meat of the matter, Pattu. What have you got against individual stock investing? I like
Hello.
to put you on the spot.
I don't have anything against individual stock investing. I just have a beef against many people who want to invest in stocks, and they want to invest in stocks I would say, for the wrong reasons. Um,
Oh, interesting. So if you had the right reasons and we'll identify what those are, you're okay with that.
I am, yes.
Is wanting to accelerate net worth quicker than mutual funds a good reason?
A terrible reason.
Okay, so what could be a good reason, Pattu, to invest in stocks?
um, okay, so I think a stock investor should should be passionate about holding businesses, a good rock solid business that will grow in time, and they should have the temperament to understand businesses. People today are in a hurry to invest. They look at people on social media. There are many people on social media who flaunt their portfolio and say, oh, I made 30x 40x on this stock, that stock, and this is
Not
my.
only that, but too, I'm noticing on social media, people are even flaunting their futures and options and encouraging more and more people to. And God bless Zerodha, because I just logged in for the last 1 week, and every time you log in, for the first time, it puts up a big message. 9 out of 10 individual traders in equity futures and options segment incurred net losses. On an average, loss makers registered net trading loss close to 50,000 rupees. Over and above the net trading losses incurred, loss makers expended an additional 28% of net trading losses as transaction costs. Those making net trading profits incurred between 15% to 50% of such profits as transaction costs. Anyway, this episode is not about futures and options, but it's getting a little scary on social media, right, Pattu? Um, but but please continue about people
Yeah,
sharing
so
their
uh,
portfolios.
yeah, so that's, first of all, that's God bless SEBI, because
Exactly.
that's not zero there. That's
Fair
a step,
enough.
but unfortunately, it's like the warning on a cigarette pack, right? That you have a huge cancer warning on a cigarette pack. People still smoke every day, I don't think
It
it's going
becomes
to
a
change.
blind spot after some time.
Yeah, I mean, it's going to probably make an impact to those who bother to stop and read and understand what it really means, but to a large extent it may not, but it's a step in the right direction nonetheless. So so there's a lot of noise around stocks, and of course we're not going to talk about trading. We're not going to talk about derivatives here. We're only talking about investing, and that means long term investing, which by definition means that the churn in the portfolio is less. You're not going to keep changing your stocks in the portfolio every couple of weeks or every month, even maybe even a year or so. So it's a very long term kind of approach that you're looking at. Even here, the problem I have with many investors is that they have this, they see stock investing as a get rich quick scheme. They want to become wealthy quickly, and that almost always never ends well. And they see stock investing as a kind of replacement for the low capital that they have. So they don't have much of money to invest. Most of us don't have money to invest. I mean, we have
I've been
expenses.
guilty of that. You've put it so well into words, Pattu. It is to make up for the lack of capital. Beautifully put. Please continue.
And again, that doesn't end well. It never pans out that way. And we have talked about this before. You need money to make money. You cannot make money with returns. Of course, returns are important, but if you chase after returns, then you are also chasing after risk, because risk is the shadow, and most of the time you're going to end up with the shadow and not the reward. So that's the big problem. So it's a I would say it's a temperament or an attitude kind of issue that I have, where you are investing in something for the wrong reasons. That said,
Wonderfully put.
I know people who are genuinely interested in researching about businesses. They want to learn how businesses operate, what are the kind of challenges, how do they face up to competition, and how do they keep the business running over decades, and they want to a slice of that, that profit and loss, whatever it is. It's a double-edged sword, and that's absolutely fine. But the point is, we can afford to experiment with our passions, with our hobbies. Why experiment with our wealth? Let our wealth grow systematically via, as we mentioned in the previous episodes, a simple index fund is enough. If on top of that, if you still are passionate about stock investing, about researching about companies and investing, then make it a small satellite portfolio. Make it a small segment of your portfolio, maybe 10%, maybe 15-20%, up to 20%. I would say it's okay, and that's okay. You can do whatever you want there, whereas the systematic investing continues, and
Right.
that's the simplest way to go about it.
But when do we cross that fine line of stock investing becoming gambling?
See, if you have the right vision about why you really want to invest, then it is not at all gambling, I would say. Even in the case of trading, there are many people who trade with the right mindset. I don't have anything against traders. It's wrong to say traders are all bad and so on. They play a big role in holding the market up, in providing liquidity and so on. But it's just the mindset with which you enter. People want the reward without the effort and without going through the risk. So it's like what Dolly Parton said: if you want the rainbow, you have to put up with the rain. And that's the problem. So there are many people who are ready to put up with the rain, who are ready to go through that grind, whether it is trading, whether it's futures and options or investing. I have nothing but respect for them, and they won't be asking questions like, should I be investing in stocks? I mean, if you are asking somebody else, it means that you have not asked yourself that question hard enough. You don't have that clarity. If you have that clarity, that's absolutely fine. The lack of clarity is what makes me worried.
And Patu, I absolutely love the idea of exploring businesses, and I love this world of understanding how a business works. But I think most of my stock investing, and if I'll be brutally honest, I might represent a pretty large market, has been to try and buy large cap stocks that have proved over years to have great returns without not knowing enough about those companies, which has kind of held me in good stead, right? Because it's probably part of the Nifty 50. These stocks have done historically well. I have a lot of comfort from my family members who say, yes, that is fine. If you invest in those stocks, it's fine. And I've put a little bit of money over the years, kept investing, and thankfully it has slowly risen. Nothing great, nothing much to talk about. I guess the fun is in identifying perhaps a mid cap company or a new company without size. And then how does one study a stock? If this episode somehow can throw some light on that entire world of how does one research a stock? How does one know about this company? How does one read a balance sheet or an annual report? And I know for a fact you said before this call, you don't do that as a policy. Why is that the case? And then how does one start investing in the right way in stocks?
I think you're absolutely bang on in saying that I like to invest in large cap stocks, and I've been investing in, and I think that is the way to go. Even in that small satellite portfolio that you want to invest stocks in, it's okay to have a predominant large capish kind of portfolio, because they're established companies and they're not going to go to ruin overnight. Very unlikely. So that's fantastic. In fact, I maintain a lazy stock portfolio myself, and I started investing in this portfolio only after I reached financial independence, and it's predominantly large cap. And for me, the most important thing is a company should not have debt. It should have very low debt to equity. If at all it has some debt, it should have very low debt to equity. And if its price, it's not too volatile. In fact, there's a theory,
Right.
I forget the name of the person who said it. Buy stocks that always trade close to its all-time high. more often than not, if it trades close to its all-time high, then you can imagine the growth. It will typically be moving upward. And if you find such stocks, and whether they are mid cap, small cap is, I don't think it's unlikely to find such stocks, but at least in the mid cap segment, maybe it's possible to do it. Low debt, trading close to all-time high, that's your shortlist. You can then look for deeper, there are any red flags. Today we have screeners and we have AI. AI is going to
Yep.
change the way people are going to process balance sheets. Nobody needs to read a balance sheet anymore. You can just
What is the
feed.
hack with AI, Pattu?
Um,
I'm going to start doing this immediately after this recording.
you can upload a balance sheet, or there is a tool. I forget. Probably we can include it in the description. It just
Sure.
came to me. I'm sorry. So that has all the balance sheet data. It's a FinChat. I forget his name. I don't want to give you wrong names out. So it's $20 a month, and all the balance sheet data is available. You just need to ask when was the last time Microsoft was showed a lack of profit in a year, or when was the last time this company had the too much debt or high profit or high whatever EBITDA or whatever that. So everything comes out. You don't need to study sheets anymore. In the olden days, there are stories about fund managers getting annual reports from old newspaper stalls. That is, and now we have come to this. We now have a large language model which is going to do that to you. So it's so easy now. But at the same time, what I would like to point out is that too much of that is also not going to be very profitable. Of course, it's going to make you knowledgeable, and if you're going to spend hours in front of a AI chat or actually reading the balance sheets, then you must make something useful about it and write about it and try to monetize that, because too much analysis of balance sheets has not shown to be any more profitable than monkeys throwing darts on a newspaper. So
Right.
it's you like you said, it's a very fine line. The problem is, if you go down this rabbit hole of reading balance sheets, understanding balance sheet terms, and very few people come out on the right side. They just keep going. So they keep reading, and it's a problem. I mean, you don't know when. It's like sculpting, right? You should know when to stop sculpting. Otherwise, the statue will become a stone again. So that kind of thing happens in personal finance, particularly in direct equity investing.
Right. I'd like to correct myself because when I asked you the question, I said the real fun is when you identify companies for yourself. But fun is the worst word I could have used. I meant it's a rewarding feeling when you've done your homework and you've researched and you've identified companies and then you back your theories with a little bit of money and then it grows over time. For me, that is the most rewarding feeling, right? Not asking somebody for a stock tip, not reading the newspapers and saying this stock is doing well, etc., etc. But what you said brought back a lot of memories, Pattu. I remember back in the day when for each results, every quarterly results, you had to announce it in the newspapers. And I remember my father poring over this data, and bless him for putting in all that work. But that also brought back memories of a very popular video you posted years ago. And it spoke about how, you know, you said don't spend too much time on investing and money and get a life, right? And I have a feeling that's the biggest problem with stock investing, right? It requires so much of your time. It requires so much of your active concentration and daily consistent analysis and reading of the market. And at what point does that lose any kind of reward? For me, that's another particular issue. And another important part in that video you said was all gains are notional, but all losses are real. So can you explain that particular topic and how does one get out of that? Because I often find myself having an issue selling stocks. I just seem to buy them, just accumulate, accumulate, accumulate. I don't know if that's the right way to do it. I hear kind of in the long term it might be the right thing to do, but I have an issue selling stocks because kind of get attached to them. So I know I've asked a lot of questions, but first the notional versus real, profit versus loss, and then the second question.
Okay, I just had a quick look. The website I mentioned is finchat.io. So you can look that up.
Finchat.io. Fair enough.
Yeah. So
This is not
that's the
sponsored, guys.
it's so that's the first thing. So the second thing is, if you talk to experienced stock investors, and I've had the privilege of talking to several of these people, and these are crorepathies who will, walk around the streets with ugly dhotis. You would not even know
Absolutely.
that. No, they're extremely humble, and they would tell you that the first thing you should realize that everything is in hindsight. I've had multi-baggers in my portfolio, but yes, I was confident about them along the way. But uh, I mean, I can say that today it's 30x, 40x, 25x only in hindsight.
Mm.
So, but I
Nobody
had
can
to,
predict the future.
yeah, I had to bear the risk, and the risk is in the journey. The reward is always in hindsight. That's what I mean by saying all gains or losses are notional. Everything is notional until you pull out the money from the broker's account. It's all notional. So there's, I think, a significant amount of humility is necessary for investors to stay grounded, to understand. It's like what I saw in a Korean movie about mountain climbing. There's a saying, um, you can climb a mountain only if the mountain lets you. So it's the stock market is that kind of a mountain. It's a multi-fanged beast, and you don't know when it's going to embrace you, give you a ride, or hit you, hurt you with the fangs. So there's some humility is necessary, I would say. And one is the other question you asked. If I keep
The issue with these, it's all notional. You're looking at your stuff on screen. Your entire a part of your net worth is literally a number on a screen. It's completely notional. It's almost bizarrely, sometimes I think about it, am I living in the real world, right? So are you suggesting, or what is your answer? Should we regularly pull out profits, or should we regularly make sure it's hard cash in the bank? How does one deal with this discomfort of being purely notional? My entire net worth is notional.
See, it's a very tough question to ask, and I think there's not much of literature on this also. In fact, I also have wanted to write on this. I've not written on this. So I would say, as an investment, we first look at our goals. Nobody is going to give us an award for spotting a multi-bagger. Nobody is going to, give us a special dinner for being a good value investor. Nobody cares, or I think we should also not care about that, because ultimately what matters is money for our future needs. That is the bottom line. Whether you choose stocks, derivatives, whatever, ultimately it's money for our needs. So that is the first criteria. The next is, what is the asset allocation that I need to use, and we have talked about asset allocation repeatedly. So typically it's equity fixed income mix. So in that, the equity, we are saying very few investors can tolerate a 100% direct equity portfolio. 100% stock portfolio is extremely risky because the concentration risk, because you can't invest in 30 stocks or 50 stocks. It's not possible. I mean, I know investors who say they hold 75 stocks, but it's just there. It's just clutter, which you are. It's some of them are just past mistakes that are just gaining cobwebs. I know that's not a good portfolio. A good stock portfolio has to be conviction based. So by definition, it has to be. It must have concentration risk, in the sense that you can have 10, 15 stocks at max. Beyond that, it's you don't really have you're spreading yourself too thin. But the point is that stock portfolio is always going to be riskier than any mutual fund portfolio, whether it's actively managed or passively managed. And we should appreciate that concentration risk. If you don't, because then it can be trouble. So what that means is, concentration risk means if it delivers, it's going to deliver huge, and if it fails, it's going to fail by a huge amount. So without appreciating concentration risk, I don't think anybody should get into stock investing at all. What do you do when you suddenly see your portfolio and it's like 25% returns overall, and each of some of those
Exactly.
scripts
Yeah.
have got 45% gains, 50% gains, and so on? I think you should look at two things. One is you should look at when you need the money. Two, you should look at your asset allocation. If because of this huge gains, most likely your asset allocation would get skewed. Let's say you started out with 50% equity and 50% fixed income. Typically, your asset allocation may have gone, because of these bumper returns, let's say it would have gone 55%, or maybe even 60%. Pull out money.
That happens all the time, Patu. I mean, that's something
Pull out
I've
money from
noticed.
equity and rebalance it into debt. We shall talk about rebalancing in a special episode altogether. That's because it's a very important topic. But this has to be done from time to time. The problem is people see a stock giving 45% and they don't want to, sell. They just don't want to
That
sell.
struggle is real.
That
It
is
just
where the
my
maturity is
mind doesn't
important.
allow me to sell. Yeah.
That is
and
where the
and I have a
maturity
very
is important.
close friend who's a broker as well, and God bless him as well. And his main education to me over the years has been, why do you get emotionally attached to a stock? It's just money. It is just another stock, right? When you've got your returns, how do you? And I don't know, maybe it's just natural human behavior to say, look, this stock has done so well for me. Do I really need to pull it out? I don't even need the money right now. Should I keep it in? But the whole point is about rebalancing and managing your risk. And as Patu said, that's a separate episode. Um, Patu, I have a very strange question. We've always mentioned on this show, just if you have to do equity, which is 50% of your portfolio, which is what you had suggested, do it in mutual funds. Say, stick to the Nifty 50, right? Nifty 50 fund. If I had put the same amount of money in the Nifty 50 fund, say across 5 years, and instead invested that money directly in those stocks of the Nifty 50, would my returns have been the same?
Unlikely, because the churn, because the Nifty keeps changing, uh, because of market movements. And of course, I'm not talking about stocks moving in and out. Even if you assume that the stocks are going to be the same, the proportions are going to vary. And tracking the Nifty by separately investing in direct equity very rarely works. Sometimes it will work, sometimes it will not. And I would, because when you invest in a mutual fund, you're not paying tax on the churn, right?
Right.
But you have to pay tax when you are either investing in direct equity on your own, or if you're investing in curated stock baskets. Curated stock baskets are, they're popular today because they have these back tests which show huge returns and so on. But those back tests don't take into account taxes often, and these tests are are almost always done over a short period of time, right? And you don't know what the future holds. The churn could be higher in future, so it's very difficult to do it. I would say, if uh, if you don't have conviction about investing in stocks, or if you don't particularly care about businesses or anything like that, you say I just want returns, that's absolutely fine. Stick to mutual funds, particularly index funds. But if you're passionate about businesses, keep it as a satellite portfolio, maybe 10% or up to 20%. Some people even remove it outside from their goals, right? They say, I don't want this to be part of my goals. This is my, playground, out of my sandbox. I want to learn. So that's even better. Then you don't even, if you're going to remove it out, then that need not be part of your main asset allocation. So you have a lot more freedom, but you should be careful to sometimes you have to switch gains out, maybe to cash and push back in. But that's something that you have to learn. There's nothing like what they say, the University of Hard Knocks. You have to go through that with respect to the story, because there's no easy route.
Now, this issue of returns, Patu, is another tough one, right? A human being is never satisfied, right? And once you beat inflation, uh, then you have market returns. When you're in mutual funds, you have, say, for example, index returns. and then that stops being enough, right? And then you start wanting to beat the market. I mean, that's the bottom line of this question. How does one deal with that greed? I just need to grow my net worth faster. You know, 14% a year is not enough.
I
And,
Yeah.
that struggle, right? It's real. This is what the real struggle is on a daily basis for most listeners.
So no, the problem with that is that greed can become all encompassing. We talked about a small portfolio, 10%, 20%. But if somebody is greedy, then what they do is they start looking for information. The biggest problem that I have with stock investors are they get into all sorts of WhatsApp groups. They get into every
Mm.
Twitter spaces that there is. They want to get information. I want to know. If I don't know, I'm going to be left out. And so soon you're going to be, for something that is only 10%, 20% of your portfolio, you're putting 80% effort. It just makes no sense. And you claim that it's all passion. You're not going to learn anything from noise. If you of course there's a lot to learn, but you can't learn from noise. And social media, 99% is noise, right? So that is the problem with that greed. Usually there's not much we can do about it. Life will take care of it. I mean, a couple of market cycles, and then you know what's important and what's not. See, like I said, nobody's going to give us a award for picking the biggest multi-bagger, or having the 45% returns in the people. Also, this is the problem. 45% returns doesn't mean anything. How much of it is in your what weight does it have in your portfolio? That's what matters. So I mean, you can't do anything about that. We can only talk to convince people who have low expectations, who say, I want maybe 1% real return, 2% real return. That's absolutely fine. I mean, if inflation is 8%, if you expect 10% from a direct equity portfolio, not over 5 years, 10 years, I'm talking about a 30-year period. Have a long-term vision. 10% return over the next 30 years from 2023 is a huge reward. 10% after tax. That's going to be huge. And if you keep it that low, I mean, if you expect less, you're going to be disappointed even less. So that's how it.
It's amazing how philosophy and investing always overlap each other. But it's strange how this topic, the more you keep asking, in contrast to the previous episodes, uh, the lesser the answers become. It's almost like we're repeating the same thing over and over again about stock versus mutual funds. And this is an
Unfortunately.
episode that the mutual fund companies and fund managers are going to love. Uh, but yes, the truth is the truth. And on that note, I must thank listeners who've written in after our medical insurance episodes. I know we left so many questions unanswered. Pattu will try and respond to your emails as well. I know some of you all have emailed. And of course, we might reassess that topic in some time because it's so vast. But yeah, on the simple fact of stocks versus mutual funds, and risk, and the close friend who is a stockbroker, I told him about this recording, and he said it's very simple, right? When If you learn how to be an F1 driver, you can drive that car. Um, However, you leave it to the experts, right? People who spend so much of their time um, researching and studying and doing it full time almost, that you hire a professional driver, right? That's what stock investing is all about. And the professional driver, of course, is the mutual fund manager if you can't do it yourself. But on that note, any last words about this topic, Pattu? And
Yeah. So one thing I quickly like to mention is that I strongly recommend all direct equity investors to benchmark their portfolio with the market. That is, if you had made 10 trades, buy, sell, over the last year. So let's say you started a year earlier and you just made 10 trades. Make those transactions with a NIFTY or a Sensex index fund. So identical transactions, buy, sell, excluding dividends, and find out what the return is. How your portfolio would have grown had you invested in a index fund instead of the direct equity. That will tell you what's happening. I mean, if you are one of those return chasers who don't like to research too much but want to invest on scraps of information that you find here and there, particularly this benchmarking would be of use. After a few years, you can find out how difficult it is to beat the index. And
Sure.
but on the other hand, there are people who are passionate, truly passionate about investing in stocks. For them, it's okay to benchmark, but they would still not bother too much because that's their passion. That's what they want to do, and that's absolutely fine as long as it's not a disaster. I mean, if the Nifty can be 17% and your portfolio can be 12%, that's absolutely fine as long as you say, look, I enjoyed what I'm doing, and it's not affecting me emotionally. I'm not spending too much time on this portfolio. It's just a hobby that I like to occasionally, work on it. Then it's okay. So
Sure. So don't experiment with your wealth. You can experiment with other things in life, is what Pattu's message is. Perhaps later in the months ahead, if Pattu will indulge us, we might deep dive into how you research a stock, how you read a balance sheet, etc., etc. But for now, the top 2 tips by Pattu, and correct me if I'm wrong, Pattu, is one: look for low debt companies or zero debt companies, and companies who typically continue to trade near their highest levels over a period of time. I think those 2 basic benchmarks will help you identify solid companies. And on that note, thank you. Please keep writing in. As we keep saying, the show is nothing without you. You know how to reach Pattu. You know how to reach us at Offspin Media Friends. And keep listening to Let's Get Rich with Pattu. Thank you so much, Pattu.
bye bye.